This conference will now be recorded.
All right, guys, good afternoon. Welcome. Welcome to the Clear Lines training session. I'm your host, Kipp Cohen, here for the next just about 60 minutes to answer your questions about the Clear Lines indicator running on the MedVed Trader platform. This is a twice weekly training session every Tuesday and Thursday at 3 o'clock Eastern. It is geared for the subscribers of Clear Lines or for those that have interest in learning more about the Clear Lines indicator, as well as the MedVed Trader platform and equity-alerts.com. If you have a question, you could submit that through the GoToMeeting chat. If you have questions outside of this training session, you're welcome to email me, kip@equity-alerts.com, or call me at 972-841-8886 or text me. So today I wanted to focus our energy on money management. And I am recording this session, so I will post this to our YouTube page. But I wanted to talk about money management and trade size and any other topic related that you guys want to discuss. So one of the first things I wanted to mention that I feel is the double-edged sword, which is leverage. Leverage, it's great when a trade goes in your favor. It's horrible when it doesn't. Um, Markets like Forex are highly leveraged, and traders in that market, if you're not careful, you can wipe out an account pretty quick. Um, Futures trading is leveraged. If you're not careful, if you're you can easily lose a lot. Options are highly leveraged. Options you can lose. I mean, everything you've got into the trade because it's a contract. So this also is a double-edged sword when it comes to trading stocks, because if you're trading on a margin account, intraday you have 4-to-1 margin. So on a $25,000 account, you could have 100,000 in buying power. On a $100,000 account, 400,000. On a $250,000, you've got $1 million in buying power. So one rule that I have kind of taught over the years, and I'm a believer of, is what I call the 10-10 rule. And there are variations of the 10-10 rule, but the 10-10 rule basically says don't ever put more than 10% of your account into a single trade with a stop no greater than 10%. Okay. The reasoning behind that, and let's use a $100,000 account as an example. If you put 10% of your account, and I'm talking not a leveraged amount, but I'm talking your account. If you put 10% of your account into a single position, that's $10,000. Okay. With a 10% stop loss, that's $1,000 risk. So worst case scenario is you lose, if that trade goes against you, you lose 1% of your account. You're not going to get devastated losing 1% of your account. It's not going to feel good, but it's not going to be devastating. Okay. So how do you vary that? The variations of that would be, all right, well, if I'm using leverage and I'm still want to only risk that technically 1% of my account, all right? So you could theoretically buy a $40,000 position with 100,000 in the account. You just have to have a smaller stop, or you're risking instead of 1% of the total, you're risking 1/4% of the total. So if you have 40,000 times 0.25, whoops, times 0, 0 point, quarter percent, 2.5%, sorry. So you're risking 2.5%. 2.5%. If you had 40,000, instead of a 10% stop, you could have a 2.5% stop. That's $1,000. Okay. 2.5%. All right. Does that make sense? So again, here's the calculator. If I put 40,000 into a trade, right, times 0.025, that's $1,000. So that's 2.5%. So your trade, your max, and that's your maximum pain threshold. That's your worst case scenario, right? That's your catastrophic stop is 2.5%. On an active trade, you're probably, or you're very rarely going to go, for a 2.5% stop. I mean, your stops are probably more like 0.5%, 1/4%, 1% maximum. Again, this is the catastrophic stop loss. Um, Good afternoon, Alvaro. You could also theoretically put 50,000 into a position and risk 2%, right? 50,000 times 0.02 is $1,000. So that's the catastrophic stop, okay? This way you're never risking more than 1% of your account in a single trade. But I called it the 10-10 rule because the 10, 10%. Really, if you're a longer term trader, if you're a swing to intermediate or position trader, stocks that you're going to hold for an extended period of time, you're not going to want to risk much more than 10%. If you think about it, when you're swing and position trading, your stop's got to be outside the ATR. Swing and position trading stocks, typically you want to find something that's got a 2 to 3% of the price of the stock ATR. So, you're going to have to go with a stop that's going to be 8 to 10% just to get you out of harm's way of that trade. So even if you're in 10 positions, okay, 10 positions on 100,000, you're fully vested, you're still, if you have a 10% stop loss on each trade, your maximum exposure is 10% of your account. So again, if every stock had something catastrophic happen and you got stopped out of 10 positions, again, you're going to take a bit of a hit, but you're not going to devastate your account. And like I said, you could have 20 positions with a 5% stop. If you could do variations of the 10-10 rule. Okay. So one of the great things about the MedVed platform is that you can set it so that your trade sizes are based upon the amount you want in your trade. So if you go to click Show Dashboard, that's the little, I call it the Rubik's Cube, the little multicolored box, which is at the upper corner of every chart and up at the upper corner of your index window. It's also down on your taskbar, your main dashboard, the full size dashboard. So there's mini dashboard and a full dashboard. Okay, and then if you click on settings, if you go to where your accounts are, you pick whichever brokerage account, and we'll just use this Choice Trade account. You go to your account, and then you go to where it says quantity stocks. So right here, it says transaction value, right? So if I don't ever want to risk more than 10,000 in a single trade, then I can put 10,000 right there. That's my max. And I can pick a minimum number of shares, 50, and I can round it to the nearest 50. So what happens is, so let me go to the choice trade. So let's say that I want to trade the diamonds right now. If I wanted to trade the diamonds, it's automatically going to put in the default number of shares based on the trade size. So now that's a $16,000 position because I put a minimum of 50. So I would have to go back in. Let's go back in and change the minimum to 10. All right, instead of 100. Minimum 10. Round to the, oh, I need to change the round. Round to the nearest 5 lot. Okay. So let's try that again. Why is it not? Hold on. Something's not going right. Hold on. Oh, 10,000. Let me try a different stock. Hold on. Let me try one that's not so high priced. All right. There you go. All right. Walmart. There. It's gonna round it as close to that 10,000 as it can get. So there's 12,000 right there. Let's try another one. X. There's 10,500. So it automatically put 500 shares. Oh, hold on. I think I had it set wrong. I think I was on the wrong account. Okay, let's try that again. Let me go back to DIA. Let's see if it gets it right this time. There we go. Now it's working. I had gone back and changed the wrong account. See it says 30. So if I go buy, now it's 9,600, right? It's going to automatically, I was setting the wrong account. 10,000 round up. Let's pick another stock. QQQ. So 35 shares. If I click B, 10,970. So it will round it to as close as possible to that 10,000, but it's going to do it in rounds, unless I go down and put single lots, which I can. It'll get closer if I do singles, but most people don't like trading in single lots. But I can go to down to a single lot. So now let's do DIA. Let's see how close it gets us. 32 shares, 10,252. So it's going to get you as close as it can. And you can either go round up or round down. So I have it rounding up. If I want to round down, go back, go to choice trade, and I can go round down to nearest. Let's see. $9,717. So that's less than just under 10,000. DIA 9932. SPY 25 shares 9733. So what this will allow you to do is, if you set it up for your account, that way automatically every single trade is always the same dollar amount. Always the same dollar amount. So that you're not trying to figure out, because time is of the essence when you're trading. So if I want to change and go, well, I want a $20,000 position, you can just go back to that account and I can put transaction value 20,000. Right? Still 10 minimum, round to the nearest one, or maybe I'll round to the nearest 5. Okay. Round down. If I want to limit how many shares, that's a limiter right there, 15,000. So now let's put in diamond. So now I can trade 60 by 19,224. So my positions will always be the same dollar. Okay. It'll automatically calculate, round the shares, the nearest 5 to as close to 20,000 as possible. Now, sometimes you may start a position at a half size. So the easiest way to do that is pick your full position size, leave it like that, but then go click here and then just change it to 30, cut it in half. So then you're halving the position size. That's the easiest method. Just half the shares. So let's pick something to try this with. Let me find a stock that we can test the theory. All right. So let's say I'm liking Apple up here to short, okay? But I don't want to start my full position, right? That would be 180 shares, 160 shares. So I'm going to just scroll it to 80. So now I'm half position. So I'm going to initiate half entry here. All right. Starting half. Starting small would be, yeah, like a quarter or half, 25 or half of what you would of full position. Um, and then let's say I want to go ahead and put another quarter on, right? So I could put another quarter on. So a quarter of that, of 80, would be 40, right? 80, yeah, because 80 is half, so 40. So if it's starting to work in my favor, and I'm like, all right, well, let's put another quarter on. And you can see right there, the position size was just under 5,000. So that would be a quarter of 20,000. So now we're at 120. And then let's put a limit for a target. Let's say we're looking for VWAP. So we set our limit order down at VWAP, maybe a little bit above VWAP. Crap, what happened? It's, I don't know what just happened. This thing's stupid. This um, demo thing just screwed up.
Did it fill that order for you? Did you buy 120 shares?
Yeah, this is my my choice demo account I was playing with. I don't know why it bought it all the way down there. That was it shouldn't have filled, but it did.
Yeah.
It doesn't make sense. Hold on. 120, 50. That, I don't know why it did that. It makes zero sense. Something's not working right. But anyway, you kind of get the concept. Concept is if you go into your settings under your brokerage account, you can pick how much you want every trade to be so that you always have the same position size, which I think is important when you're trying to do money management. And then if you feel like you only want to start with half, then you just cut that in half. And then you can add on at a another point. So let's try that again. Let's try that with something else. There. So Nvidia, it's only 35 shares. So let's say we want to short Nvidia, but we only want to short 20. So we start at 20. Now I got to remember 35 is the ultimate, right? So I probably smart to write down that I have 15 shares left. But I can also hold on. If I put my mouse over the where it says gain, see that? If I hold on, why is it not doing? There. It shows me the value 10,000. Uh, I don't know why it's not working right, but it was showing the value was 10,000. You can also look in your, obviously in your, value. There you go, 10,000. So you can switch it to value if you want to get the value of the position and then what the actual current gain is. And then let's say I decide, all right, well, I'm ready to add my other 15 shares in. Then I can 15.
It was the concert thing one. Well, they had concerts and
Then I can put my other part of the position on. And then now See, technically that should be a bigger position. I still have another, I can put another 2,500. So I could do 5 more. Oh, it's probably because of the rounding, but I could do, because we're rounding down. That's why. I could technically do 5 more, but it would put me over because of the way I have it calculated. I said round to the nearest 5 and go below 20. See, if I
Mm-hmm.
did 5 more shares, that's 2518. So that's going to take me over 20,000. And I
Mm-hmm.
specifically said under 20, round down. But if I wanted to get that position close to it, if I didn't mind, then I could throw another 5 on. And then now I'm fully invested in that trade, and I've got 20,127 in it. And then I can, again, set my limit. I'm not going to set a limit yet because for whatever reason, this demo account's not functioning properly, but and I can go back to gain. And so I can see I'm currently up $7. I could put a trailing stop on if I wanted to, but we can just watch it for a minute. Any questions about that whole process?
Oh,
Yeah, go ahead.
I was curious, when you're doing a short, what's the equivalent? How do you do a sort of a buy stop where I want to make sure that I want to protect myself? Let's say I'm playing the 10-10 rule and I say, okay, I want to make sure if this thing shoots up past, 550, that I just need to get out of it. Can you put a stop order on
Yeah,
a short?
yes, it's a stop, but it's up above the current price. So you're going to click on stop and then you're going to buy. And the neat thing is it's going to calculate for you how much your loss is. So on a 20,000 position, right? If I set it at $200, that's 1%, right? Apologize for that background noise. 1% of 20,000 is 200. So, which is roughly 5 points, right? On that stock.
Yeah, but are you trying to do 1% of 20,000 or 10% of 20,000?
So remember that 10-10 rule is what I consider a catastrophic worst case scenario.
Gotcha. Right.
So if I'm using leverage, let's say I'm using leverage on this trade, maybe I'm really using 4-to-1, right? So if I'm trading a lot of stuff at once and I'm using leverage, I could be up to 4-to-1 intraday. So that would be a $250 based on the 4-to-1 leverage. So then, but if I don't want to risk that full amount, that's just worst case scenario. If I'm now the flip side is whatever you're risking, your reward better be bigger than what you're risking. That's the other flip side. So you have to also know that other end. So you can click limit and then do buy and scroll your mouse to where you think you're going to take profit. So let's say VWAP right here, where VWAP is on the one. That's a 10-minute. Hold on. Oh, it needs to be a 1 minute. Okay. So if I click buy and set my mouse right where VWAP is, so I know that my potential profit is $339. So in this scenario, you're not going to be risking $1,000 because that would be an upside down risk to reward.
Mm-hmm.
200 would be about the maximum I would be willing to risk on this trade with a reward potential of 3 to 340.
Mm-hmm.
Now, remember, swing trading is a different story. So if you're swing trading, your reward potential, you should be looking for, on a stock like NVIDIA, probably 20 point, 25 point move. So at 20 or 25 points, that's 25 points, I think, is going to give you $1,000, right?
25 times 40 is 1,000. Yes.
Yeah. So that's your worst case scenario stop.
Mm-hmm.
So even at that point, you're at a 1-to-1. But what you have to do is, like on a stock like NVIDIA, you have to look at what the trading range is. So you go to the day. Again, this is in swing trading terms. So I go to the day. So here's the harsh thing. It's got a $30 ATR. So if I'm going to swing trade NVIDIA, my stop has got to be probably 50 points to be out of harm's way. It's got to be it's got to be 35 or 40 points. Okay. 35 or 40 point. This is like way too volatile. So you either have to take a much smaller position so you can give it more breathing room, because you're going to have to let it run for days. But look what it's done in the last week. In the week, 2 weeks, it's gone from 600 to less than 500. So it does move around, but that ATR, with that huge $30 ATR, if you're going to swing trade it, you've got a huge risk potential. I
You're saying basically that by that you mean you'd have to set your stops at such a wide
yeah.
Distance from your entry point, because it's possible that it's just going to swing $30.
Oh yeah. Well, that's the trading range. So it's going to swing $30 one day out of the coming
normal,
2 or 3 days. It's going to have a 30-point swing intraday. So the only way to swing trade a stock like that is have a stop greater than $30, which means, you probably got to go 35 or 40. So your target's got to be 40 or 50. And, now you're talking 10%, it's got to move. Yeah, it's got to be a 10% move. So it kind of as a rule of thumb, when stocks get over, when the ATR is greater than 5% of the price. Okay, so $500 stock, 5%, that is a $25 ATR. When it's over that, it makes it more challenging because you have to have a much broader stop. The ATR is what's considered the average true range or average trading range, and it's a calculation based on the greatest of the prior close and the high, the prior close and the low, or the high low, whichever is the greatest of those three, and then it's averaged out. It's like a rolling moving average of that. And so, and you can scroll across and see, like, let me slide this up. The ATR has been increasing recently, but if you go back, the ATR was only, 12 points back here. I mean, it's a little out of line now. The problem is there's so many stocks that have their trading ranges have opened up so big, they're very difficult to swing trade. I wouldn't swing trade a high ATR stock. If the ATR is probably much more than really 4% of the price, it's a little out of line. It's a little too great. So mathematically doesn't make sense because you have to go so deep on the stop. Now, what it makes good for is an active trade. And look at our trade. We're already up $100 on our 40 shares. So we're already over a $2 gain in this position. We could put a trailing stop on. Let's do that. Let's do a trailing stop now. So we're short, so we need to do a buy. Let's see if this will work. And it's NVIDIA, so we got to go probably 50 cents because it moves around. Okay. And it tells you right here, if we get stopped out, we're going to make $99 because we're going to give back some. All right. So I don't know if this is going to work right, but we'll try. I don't. This is my choice trade demo account.
Mm-hmm. But you're picking trailing stop there. That's you're saying I'm going to preserve a minimum of a. Oh, I see. It's a trailing stop. So you're just going to say I want to stay that much below what the. Oh, what is it saying?
Well, what it does is it didn't function as. I mean, it functioned okay. It took us out. So the way a trail is supposed to function is it's supposed to move down with the price, but it doesn't move up. So what happens is it's kind of like a ratchet. Think of a ratchet. Ratchets go one direction typically. So it ratchets. If you're short, it's going to ratchet down, but the price won't move up. It'll click down and trail by however much you want. Let's call it 50 cents. It's going to trail by 50. But if it jumps 30, it's not going to come down or it's not going to move back up. It's going to stay at that point. And then if it drops 80, then it'll start moving down again because it's more than 50 cents. So think of it as a ratchet. Ratchets one direction. If you're long, it ratchets up. So it'll follow behind the price, behind the current price, by however much you decide to trail it by or ratchet it by. So here's my 2 cents on trailing stops. Okay, I'm just going to give you my quick 2 cents. They're great when you've met your goal in a trade, but you're trying to squeeze out a little bit more and you want to do it unemotionally. All right. So like this trade, we were already up $2, over $2. So unemotional. Let's just throw a trail in, and if we get more out of it, we get more. If not, we're going to still get our $2. It becomes unemotional. What I don't like about trails is that you're not really in control. I prefer to manually trail it myself and be in control of where I'm setting the stop, because that way I can see where price is and where the pivots are, and then make adjustments accordingly. Or if I'm looking at fib levels, okay. The the difference is that if stock's moving real fast, the action gets real quick, the trail is going to help you out. It's going to help in those real quick moves, but you may end up giving it back. It's kind of a 50-50. It's one, yeah, they're both have benefits. I just like to be in control myself, but using a trailing stop, like I said, once you've met your goal or exceeded your target, I think they can be pretty handy. They can be, again, it becomes an unemotional trade because at that point you just say, all right, we'll trail by X amount, and if I get more out of it, hurrah. If I don't, then I know my worst case scenario. It's whatever you're trailing by, you know.
Right, it's good.
But this was good example because we started with 20 shares, we added 15 more, and then we topped it off with 5 more to get to our full 20K. And then obviously then it just dumped, and then we threw our trail in, and then we locked in our 2 points. So that was pretty awesome. I wish they all were perfect like that. So, hey, Barney, good to see you with us. Barney is here. Barney's an all-wise trader joining us for the first time. And he hasn't, this is the first time he's seen the platform. So this is the MedVed Trader platform that we use. Um, I'm gonna pop up a pure chart so he can see. This is a 8-minute. This is just clear lines up above. So some of my pure clear lines traders, this is what they like. Some of the older wise traders, they just like the clear lines by themselves. This is another indicator that we use, a commodity channel index. But I use a combination of a half minute, 1, 2, and the 8. The 8 gives me the intraday trend. And then I use the half 1 and 2 for timing entries and exits. And then we use a combination of a bunch of other technicals just to help us with potential turning points, places to take profit. And anyway, and as you saw, you can trade directly from the platform. It integrates with a lot of different brokers. So going back to the whole money management thing, I can't stress enough the importance. And I do want to spend a couple minutes talking about the 5 outcomes to every trade, because I like to remind everybody about that. Actually, I believe I have it posted on our website. I think I have it posted under our external blog. And I got this actually from Chris Irvin, who I used to work with at Wise Trade. This was something that he had written. And then, by the way, if you haven't been on here, there's a lot of great stuff on the blog. The core trading strategies with the overview video is posted here from our YouTube page, along with all the PowerPoints. These are the core strategies that I've developed using this layout. There is the article on stacking the trading odds in your favor, development of a trading plan. Maybe I don't have it posted. I thought I had that. Maybe is it over here? I don't. Hold on. I have it. Give me a second. I should have had this ready. Now, market's selling off too, right down here at the end of the day. I don't know what just happened. Okay, this was 5 outcomes, possible outcomes from Chris Irvin. And I love this article because to me, this is what money management is all about. This is the core rule of money management right here, right? And now I'm just going to read this. Okay, so you're a trader and you've been struggling with money management. When you use a stop loss, it seems like you get taken out almost every trade, sometimes prematurely and sometimes not. When you don't use a stop loss, get some wins and some really big losses. It is getting very frustrating, not to mention expensive. Here is something to consider. In any one trade, there are 5 possible outcomes. You have a big win, a small win, the even or flat trade, a small loss, and a big loss, right? That's pretty much every trade. Only one of these possibilities, the big loser, has the potential to destroy your account. The best protection from the big loser is a wisely positioned stop loss that limits your exposure. In the book Millionaire Traders by Kathy Lean and Boris Schlossberg, and they're both, I believe, big Forex traders, there's an interview with a trader referring to himself as Indy Jones. He claims that fame he took 25,000 trading account to $1 million before he was 30. On page 210, Indy gives us his thoughts on risk. The number one rule in trading is the same as the number one rule in boxing, which is to always protect yourself. No capital, no trading, no life. He states succinctly. So how do you protect your capital? Always know your worst case scenario. Before you place the trade, figure out what you are willing to lose in terms of points, ticks, and dollars. Check your risk reward ratio. That's one thing I've talked about. And make sure that no one trade has the potential to destroy your account. As a general rule of thumb, Indy Jones does not like to lose more than 5% of his equity on a single trade. See, he's willing to lose just 5%. That is even if the trade becomes a loser. He can still survive to taking it. Well, that's 5. See, I say 1%, right? 10-10 would be 1%. He's willing to go 5. He's willing to go deep. Indy is he's probably a Forex trader. Indy is really eliminating the big loser. Once the big loser has been dealt with, you are left with 4 possible outcomes. Big winner, small winner, even flat, small loser. With these 4 possible outcomes in play, logically, how does our trading work out? With an average ability to recognize proper entries, your small winners and small losers should cancel each other out. If that happens, you're left with 2 possible outcomes, a big winner and flat trades. Even if those are your 2 only outcomes you had to deal with in your trading, do you think you could make some money? So here was an example. This was a trading day, right? This was an example of one of my days of alerts. So there are 1, 2, 3, 4, 5, 6, 7 winners. 1, 2, 3, 4, 5, 6 losers, and 1 flat trade. Right? So almost 50-50, close to 50-50. 1, 2, 3, 4, 5, 6. Yeah, almost 50-50. 1, 2, 4. Yeah. So even with a near 50-50 day, if you eliminate, now I had one, which you could call that, well, that was Microsoft $1.26. So that's not really a big loss on a $200 stock, but there's nothing dramatic here, right? There's several small losses, 23 cents, 13, 22, 20, 16. There's some small gains, 27 cents. That's a flat, a penny, 25 cents. But then you got $1.61, $1.01, 58, 206, 54. So at the end of the day, that was still $4, right? And even if you're 50 or 60% accurate, you're cutting your losers and letting your winners run. If you're eliminating the big losses, at the end of the day, you should be ahead. Right? Today, here's my day today. 1, 2, 3, 4, 5, 6, 6 winners, 3 losers. Biggest loss, 43 cents. 43, 34, and 21. Those are the losses. The gain, 74 cents, 44 cents. 578. Now that was Amazon, but still 5 points, almost 6. $1.55. That was Nvidia. 25 cents, 9 cents. That's 7, almost 8 points. And most of my days are like that. If you go back and look, all right, yesterday, 1, 2, 3, 4 winners, 1 loser, $1.08. 1, 2, 3 winners, 2 losers, 79 cents. 1, 2, 3, 4, 5. 5 winners, 1 flat. Did I really have a flat? Is that a typo? Oh, hold on. Got to check something. Did I forget to write that down? Hold on. I'm missing a couple days. Oh, 3, 8. Oh, 3, 5. Oh, hold on. Oh, that was right. Yep. I had a flat on Facebook. Anyway, so what was that again? 1, 2, 3, 4, 5. 5 winners, 1 small loss, 1 flat, $1.94. 1, 2, 3, 4, 5 winners, 3 small losers, 21, 18, 18, $1.91. Right? 1, 2, 3, 4, 5 winners, 1, 2, 3, 4 losers, 205. Most of the losses were small. This is money management. 1, 2, 3, 4, 5 winners, 1, 2, 3 losers, $1. That was basically a flat. I wasn't hitting anything good that day. Here's 1, 2, 3, 4 winners, 1 loser, $1.85. 1 loss, 20 cents. Are you seeing a pattern? 1, 2, 3, 4, 5 winners, small loss, 260. Seeing the pattern? 1, 2, 3 winners, 2 losers, 1 loser, a little more than I wanted, 73 cents. 1, 2, 3, 4, 5, 6, 7, 8 winners, 2 losers, 213. Biggest loss, 57 and 27. Only 2 losses. This was a losing day, okay? Don't have them often, but this was a losing day. That's the first losing day in a while. 1, 2, 3, 4 winners. 1, 2, 3, 4, 5 losers. I had a hard day that day. Lost $1.36. And one went a little deeper than I wanted. $1.10 loss on RCL. That, see, if it wasn't for that one stupid loss, wouldn't have been so bad. There was another tough day. Flat, 2 pennies. Because I took a few big losers that day. $2.39, $1.12, and $1.57. That day stunk, but still flat. Some days can be challenging. Here's a good day. 1, 2, 3, 4, 5 winners, no losers, $6.95. Here's a flat day, minus 28 cents. Some days are harder, 14 cents. That's mediocrity, 34 cents, mediocrity. 1, 2, 3, 4 winners, $1.19, no losses. 1, 2, 3, 4 winners, no losses, 230. Anyway, I mean, we could do this all day long. My point is, guys, is that is your key to being successful is eliminating the big loss, trading the right size for your account. You have to make that decision. I can't decide that for you. You have to decide. But, some variation of the 10-10 rule is important. Wes says, it's good stuff. I'm going to keep at it and see if I can get the swing. Off to another call. Thanks for having the session. Yep, money management. Yep, thank you. You're welcome. And by the way, look at Apple, still going down from where we were in earlier. Still going down. Dollar drop. Yeah, probably the two biggest takeaways I can give you. Okay, two biggest takeaways: don't ever over leverage, right? Try to follow some variance of the 10-10 rule, so you're not ever risking a maximum more than 1% of your account. That's worst case scenario. That's catastrophic. All right, that's number one. Number two is eliminate the big losers. You can eliminate the big losers at the end of the day, at the end of the week, at the end of the month. You should be ahead if you follow those rules. Look, if you're with us trading the alerts and you're using proper money management, our results speak for themselves. Y'all see that every day, day in, day out. All right. What happens is when you break rules, when you take rogue trades, when you over leverage, take too big of a position, when you go too deep and take too big of a stop out, is when you can get hurt. That's the biggest way a trader can lose in this game is take big positions, big percentages of account, over leveraging, and take a big loss. You can literally wipe out a chunk of your account, especially if you're trading something highly leveraged like futures, options, and Forex. Those three, you have to be extra especially careful because of the leverage of those together. But I want to thank you guys for tuning in today. If you have specific questions about what we discussed, if you need some assistance, you're always welcome to contact me, Kipp at equity-alerts.com. You can call or text me on my cell phone, 972-841-8886. I'll be back on Thursday for another training session at 3 o'clock Eastern. These are every Tuesday and Thursday. And I know I will see a bunch of you guys in the morning. So thank you for tuning in and have a great evening. I will see you guys later. Bye-bye.